What is a product cost versus a period cost? Let's discuss the accounting concepts product cost and period cost with some easy to understand examples. We will do high-level cost accounting for a hypothetical company called Toy Giraffe Inc. As the name suggests, this is a company producing and selling toy giraffes. We are going to classify various types of cost as either product costs on the left or period cost on the right. Product costs include all the costs that are involved in acquiring or making product. Product costs are viewed as attaching to units of product as the goods are purchased or manufactured. Period costs are expensed on the income statement in the period in which they are incurred. First type of cost, marketing expense. To determine whether this is product cost or period cost, we ask ourselves whether we can stick these costs to the giraffe. Marketing expense is a clear example of period cost. Period costs are not a necessary part of the manufacturing process. As a result, period costs cannot be assigned to the products or to the cost of inventory. How about depreciation? The answer here is, it depends. The company has two areas it depreciates: manufacturing depreciation for the factory and machines it owns, and depreciation on the office and its equipment. Depreciation expense for factory and machines is in product cost. Depreciation for the office is in period cost. Factory labor. This is clearly a product cost. Stick it to the giraffe. You need people in the factory to make the product. Utilities. Electricity, natural gas, water. Just like with depreciation, it depends. If we know how much electricity was used in the factory versus in the office, we can split the total utilities bill. We allocate what was used in the factory to product costs, and we allocate what was used in the office to period costs. Raw material used in production. This is clearly a product cost. You need raw material in order to assemble the product and turn it into finished goods. Research and development expenses for the next generation toys. This is a period cost. It doesn't stick to the product. We could go on and on with other types of cost, but I think you are getting the idea now. After classifying the cost as either product cost or period cost, we can take the next step in our cost accounting. Let's deal with the product cost first. We produce 100,000 units in Q1 at a total manufacturing cost of $500,000. Of these 100,000 units, 50,000 are sold in Q1, with cost of goods sold of $250,000. Cost of goods sold, in short COGS, refers to the product costs of those goods a business has sold during a particular period. The other 50,000 units go to inventory for future sales, at cost, $250,000. Inventory is an asset on the balance sheet. This is why period costs are sometimes called inventoriable cost. They remain attached as the goods go into inventory awaiting sale. Now that we have parked half of the product cost on the balance sheet, let's review the income statement. On the left are the toy giraffes that have been sold. This is the product costs of those units that have been sold, 50% of the total for each category in Q1. This is called cost of goods sold. On the right are selling, general and administrative expenses, SG&A, and research and development. We take our sticky notes from earlier on and place them in the appropriate area. Or in a more formal look on the income statement, cost of goods sold is right here near the top. If you take revenue and deduct COGS, you get to gross margin. SG&A and R&D are placed as a line item a bit lower in the income statement. If you take gross margin and deduct SG&A and R&D, you get to operating margin. I hope you enjoyed this short discussion of product cost versus period cost. If you enjoyed this video, then please give it a like. On this end screen there are a few suggestions of related videos you can watch next. Please subscribe to the Finance Storyteller YouTube channel. Thank you.